let's get started. First off, welcome. Let's see. Yes, this is going to be recorded. If I did it correctly, I just started the recording. Yep, I think we're rolling. So we're going to talk today, angel-backed exits, what every founder and investor should know. And I say that kind of my perspective. I mean, what I'm going to talk about is what I wish I knew. As an investor, I do M&A now. I've been doing it for 7 years. So I talk to, thousands of buyers a year. So I know, we do a lot of deals. So I know how transactions work. I know why people buy. I know why they don't buy, just because it's what I do. And I just wish I had that kind of insight when I was a founder, and so my early investor days as well. So I'll kind of talk about the things from a perspective that I wish I knew. So, feel free to ask questions or throw them in chat, and I'll try to answer them as we go along. I threw a bunch of different materials together, but just for background, computer science, electrical engineer. I was Fortune 500 company, enterprise sales, COO, VP sales, CEO, 3 smaller companies, all had exits. Was a part of acquiring and integrating a number of companies. So I've been on the buying side about a dozen times, and now on the selling side for probably 30 different companies. And we just purely B2B SaaS. So that's what we know. We don't do fundraising, although I did as a CEO, but we sell companies. Typically in the 5 to 10 million in ARR is a sweet spot. We've done some as small as 3 and 4 million, and we've done some as large as 20 million, but in that kind of 5 to 10 is the 5 to 20 is a sweet spot. So also a mentor for a number of organizations, investor in a number of different funds and a number of different early stage companies, and a board member. So what I'll talk about are, cap table and balance sheet stuff, but not your typical stuff. I'll talk about why it matters during a transaction, talk about the financials, talk about what drives valuation, and why valuation may not be the most important thing, even though it seems like it would be up front, but how structure might matter more. What companies are truly sellable? What are the keys? What metrics are important? Strategic and financial buyers. I'll talk a little bit about both of those, some of the pros and cons. And the most common is a private equity backed strategic. So you've got a mix of both. Talk a little bit about a waterfall. I'm not going to go into a lot of depth, but just something to think about, that your percentage may not be what you think it would be based on your what the cap table looks like, and some common deal structure components as well. So, okay, so cap table and balance sheet, stuff that matters. So one thing I'll just point out, particularly to founders, stock options are different than equity. All right, everyone kind of knows that, right? You issue stock options and you've got a strike price. But there are a lot of reasons why it's different, and it's not uncommon when we'll get to an exit, and there was a founder, maybe 2 founders, and they brought on a third co-founder, called 6 months or a year into the project, and the 2 founders have 50% each, and so they want to bring the other person in, and they give them options, and they give them the person wants 20% of the company, they give them 20% in stock options. So everything's great. 7 years later, they're going to sell the company. And when they do the waterfall and see how much money everyone gets, the person that thought they had 20% of the company, less the strike price, 20 becomes maybe 15, 16, 17, which isn't a huge deal, but that 15, 16, 17 is subject to full income tax. And all of a sudden that 15 becomes 7 or 8. And the other founders may have QSBS if it's a C Corp and it's tax-free. So the person's getting sometimes 40% of what they thought they would get. And it's a big deal. It's a very emotional deal. It's not just a financial thing. It becomes a pretty emotional deal where people feel deceived. Anyway, so just be aware that stock options, the after-tax money, which is what you see in a waterfall, how much money goes in my pocket, can be radically different. So think about that. So there's the cap table versus the percentage of payout. And I'm not going to go in depth on the waterfall, but we'll talk about that a little later. But if you've got 5%, again, I think a lot of people, you learn this lesson the first time. I know I did first time as part of a company. It's like, oh, you get 1% of the company. Great. Well, those are stock options. And, I learned the hard way, and it was common, and there was preferred ahead of it. So I learned later on that, you don't always get what you think you will get. And so I'm going to table this one for later. We're going to talk about the waterfall, but recognize you've got deal costs. So you've got attorneys, you've got accountants. Usually you have an M&A advisor, and you may have the company may have debt. There may be preferences. So you may think you've got 5% of the company, but once it's fully diluted, you've got stock options that are going to convert. Your 5% may become 2 or 3% pretty quickly. Talk about tax-free gain. This is probably the biggest thing. I think probably most people at Alliance of Angels know about this, but QSBS, Section 1202 of the IRS. And I'm not a legal expert, but I can tell you that it's a big deal, and there's nothing else quite like it. I mean, other than like an HSA plan, right, where it's tax-free money that goes in. There's not much out there that's truly tax-free, and QSBS is one of those. And so basically, if you haven't heard about it, if you invest in a company valued at less than 50 million at the time, if it's a C Corp and it's held for 5 years, the capital gain is literally tax-free at a federal level, and most states are following the feds up to $10 billion. So, anyone that does angel investing is investing in companies worth less than 50 million, and you get some winners and some losers. But the fact that the winners are tax-free offsets quite a bit for some of those that lose. So, and it's really a little bit unfair. I talk to a lot of entrepreneurs on a pretty regular basis, and it's kind of unfair. I had a conversation with him this morning, and he's an S Corp, right? So QSBS doesn't apply, and he's in a state that has a high capital gains. So he's going to pay 50%. He's 100% owner, but half of it's going to go to taxes. Had he been a C Corp, he's been around for 20 years. Had he been a C Corp, up to 10 million would be tax free. So I guess as an investor, as an entrepreneur, it can be a pain in the butt to be a C Corp. It's not entirely trivial to switch, but certainly on the exit side, it's a big benefit. So talk to a tax advisor about it. It's a big deal. You may end up with 50% to 100% more money in your pocket for the same outcome. Okay, so unearned income. So something most companies don't think about. If you're selling 2 and 3 year contracts, that's great, particularly if it's in a growing company, because you're self-funding the company, right, with clients' money, which is the best possible way to do it, which is great. But when it comes time to sell the company, recognize that most buyers consider unearned income as debt. So they'll take it off the purchase price. So what does that mean? It means if you're selling contracts that are worth, call it $100,000 a year, and you sell all 3 year contracts. I'll try to make this a little bit simpler. So you're pulling in $300,000 when you close a contract. Well, if you sell the company 2 months later, they're going to view most of that $300,000 as unearned income. So even though you've got the cash on your balance sheet, they're going to consider that a debt, and that can be a significant amount. It can be 10 or 20% of the revenue of the company, sometimes more, that they will try to deduct from the top line price that's paid for your company. So just something to be aware of. I will say we have been successful about 30 to 40% of the time getting the buyer to absorb that. So it's actually not deducted from the price. So there's no guarantee, but you can certainly negotiate it. It's why you want multiple buyers in the process, so you can play one against the other. And sometimes it comes out of their pocket when they resell the company down the road. It doesn't really cost them anything up front. All right, so expired notes. These are kind of some random things, but expired notes can matter. If you've got notes that might have a change of control multiplier. So say it pays out 2x on a change of control, but these notes have expired. And if the exit, had they converted, particularly if it's not a great exit, and on the conversion, they would have paid less. You may end up paying them out a premium because you just didn't deal with it. And it's not uncommon that we see people that have expired notes and they're kind of hanging around and they haven't dealt with them. It's just good housekeeping to deal with those. Either convert them or extend them or roll them over. And along that line, I know we have a lot of investors on this call, but as entrepreneurs, just be nice to your investors. I mean, some people are great. They give monthly updates, they have quarterly meetings, but some people, just forget about their investors. I will tell you, when it's time to sell your company, most buyers will want 100% sign off from their investors. Now, it's not always required, because you've got drag along rights, but usually they don't want a disgruntled investor along the way. So, and sometimes, investors and entrepreneurs don't get along, and that's just life. But encourage people to be respectful, keep them up to date. And there's a whole other story about when should you let people know that you're a part of a transaction. But in general, just treat people well so there's no personal animosity when a deal comes down. Okay, so financials. Another thing that we see a lot, almost always, is cash accounting, which is okay, and most of the buyers we talk to are comfortable with it. Sort of. What do I mean by that? It means that cash accounting is fine, but at some point, if you're selling multi-year contracts and you recognize the revenue in the month that it's paid, well, you can't really say our company has 6 million in ARR because it's lumpy. So you really need to do some level of amortizing that revenue. And then even if you amortize it 12 months, if the client doesn't pay on exactly the 13th month, if it's the 14th month, it may look like there's a month gap. And if you just run some churn analytics, it can goof that up. So you need to do, at least at the revenue side, you're going to have to do some level of amortization of that revenue. You don't have to get into capitalizing all the R&D, that sort of thing. But you're going to want to do that because a buyer will do a Q of E, so quality of earnings, typically towards the end before they buy the company. It's like a light audit, and they'll do their own amortization. And if you haven't done it, or if you've not done it correctly, there could be some adjustments that aren't necessarily in your favor. So ideally, if it's not too expensive and you've got an accountant that can put together amortization of your revenue, that will be much more helpful, when we build the model to get it sold. And the other is just more housekeeping. Make sure your financials are clean, make sure all the revenue is properly recorded in QuickBooks or Xero or whatever you use. Make sure all of your expenses are properly recorded, that things aren't just missing. Make sure that the timing is correct. If you have large ACV, if you've got large contracts, and if it should have been recorded in November, but it was actually recorded in January, again, when you're rolling up your cash financials, or the other way around, it should have been recorded in January, but it came through in October, it can make the year-to-year revenue growth different than it might look at when you initially look at it. All right, so this could be its own discussion about what drives valuation. I'll talk through it fairly quickly. I've got a slide for each of these, but size matters. I mean, small companies there are fewer fits. They're harder to sell. Bigger companies are easier to sell. Growth is important. EBITDA, customer concentration, logo churn, net revenue retention, TAM, and what industry are you in? Is it hot or are people avoiding it? So I'm going to dive into those individually, but at a macro level, this is kind of interesting. I just pulled this up. So SaaS Capital. So, we all saw there was a huge bubble, right, starting in 20 through COVID, where it just went off the charts, right? You had 15, 20x multiples. These are all publicly traded companies, by the way. Privately traded companies, multiples, there's a discount because they're not liquid. But this is just indicative. They've been creeping up, which was quite healthy. And then it got, I would argue, pretty unhealthy, a little bit unrealistic when money was free. and now it's back down to levels that are lower, but they're still pretty good. The median is, last month was 6.9. I think now it's at 7.2. They're pretty healthy multiples for publicly traded companies. And then if you compare that against the S&P 500 or the NASDAQ, you'll see that even with the huge drop off in some of the valuations of these companies, they're still outperforming by quite a large margin the S&P 500 and the NASDAQ. So, software, a friend of mine once said, software will eat the world, and it is. And now you see AI is going to eat the world. So it's a good place to be. I've been a part of it for a long time, and it's certainly been a good place to be. I know everyone on this call believes the same thing, but there's some metrics to back it up. So we talk about size. So companies below, I'll start at the bottom. Companies below 1 million, it really has to be a special fit for the team and the tech, because the revenue just doesn't move the needle. And most companies that are doing inorganic growth, right, M&A, they want it to move the needle. And most companies are trying to grow a minimum of 15% annually, big companies, and they may struggle to get 5 or 10% of it organically. And so they're trying to bolt on 5 to 10% per year. So if you just do the math, if you're a $1 billion company and you're trying to buy 5 or 10% of your growth, that's $50 to $100 million in revenue. So big companies, what we hear most often, everyone says, "Oh, I want to sell to a strategic because they'll pay the most." But the reality is, they'll often just not want to do a deal that's less than $10 million, sometimes less than 20 or 50, but particularly less than 1 or 2 or 3 million. It's usually not interesting. Not always. I mean, there are lots of exceptions to this, but I'm just saying, generally speaking, the majority of the buyers, the strategic buyers, aren't interested in smaller companies. So above 2 million, you've really kind of proven some product market fit. Above 5 million, you've really proven it for level one. And I'll talk a little bit about private equity, but private equity loves companies in the 3, 4, 5, 6, 7, 8 million as add-ons to the platforms that they own. So that's a pretty sweet place to be. They pay well, and the certainty is high. Above 10 million, the amount of capital available where you can be a platform company or you could be a large add-on becomes pretty significant. And then above 100 million, there just aren't that many companies, SaaS companies, growing SaaS companies above 100 million. So the multiples get higher. So not only does the denominator get higher, but the multiples get higher as well. Okay, so question, unless multiple potential buyers competing, shouldn't strategics in some cases discount portion of revenues, cut off access to products to competitors? Yeah, it's true. So if you're selling to a customer, it's very likely that they may not want to sell to their competitors, who are the rest of your customers. So that can be an issue. Yep. So let's talk about growth, because growth and retention, if you don't remember anything else I say today, growth and retention is what matters the most. But also not burning cash. It's hard to sell companies right now that are burning cash. Break even is light years different than burning 10, 20, 30%. So declining, it's a little bit harsh, but I've heard multiple buyers talk about no one wants to catch a falling knife. So it's possible, but it's difficult, and you often won't get more than 1x on the revenue. Flat is actually okay if it's a good business and there are good reasons why. If you're great product and tech people, but you're not great sales and marketing people, and you haven't raised a lot of capital, like if it's an angel-backed company, that's fine. There are a lot of buyers out there that feel that they can bring the added sales and marketing expertise and drive growth. 10 to 20% is definitely more interesting. That's probably the most common. Companies in that 5. The reality is, if companies are growing more than 40%, particularly more than 100%, they're likely on that hockey stick, exponential growth. But 10 to 20 is the most common, where they wanted that exponential growth, they didn't get it, and so they're ready to sell. And like I say, the majority of the buyers, that's really what they're looking for. So logo churn is important. I've got a quote. I've got some examples on here a little bit, but logo churn is important. I would argue net revenue retention is probably more important because it kind of infers there's low logo churn, and then you've got some upsell capability as well. So, it basically just measures how sticky you are at a high level, how many people stick. And bottom right here, this pro tip thing, one of the things I talk about is the publicly traded companies often have teams that focus on metrics, and they're very, very good at working with trials, but things that aren't considered subscription revenue so that they don't hit the metrics if they bounce. So I encourage people to do the same thing. Early on, all revenue is good revenue. Any customer is good customer, right? It doesn't matter. But if you're selling to people that bounce, it can make your metrics look bad. Like if you've got a lot of sticky customers, but some bounce, find out a way to get new clients on a trial. So if they bounce, they don't hit the longer term. Net revenue retention, this is a big deal. Almost every buyer I think I've ever talked to, one of the first things they'll ask for, once they look at your financials and your balance sheet, they want to see an anonymized revenue by month per client, and they'll do their own analysis of NRR. I mean, the whole reason people pay multiples of revenue for these clients is because it's a predictable revenue stream, right? You don't, if you sell $1 million worth of coffee cups one year, I mean, you've got to sell $1 million the next year, or your revenue goes to zero. So if it's sticky, and if your net retention is 100% or greater, in theory, if you don't do anything, that business will stay the same. Or if it's 110, 120%, it'll grow 10 or 20% without doing anything. I mean, that's almost magical. And investors have realized that those are extremely valuable businesses. So net retention is extremely important. I find a lot of young companies are so focused on generating revenue that they don't spend the time that they should on client services to make sure their clients are happy, make sure their clients are actually using it. If they use it, it's more likely to be sticky, and to make sure that they're especially on contracts companies whose contracts are up for renewal. So the median net retention is about 100%, and higher is better, right? I mean, it's a big deal. Going from 100 to 101 to 102, 105 is exponentially different than going to 99 to 98 to 95. I mean, 95 is not terrible, but 105 is way better than 95. Higher ACV tend to have higher net retention rates. They just tend to be bigger, stickier contracts. And then, but SMBs, a good net retention rate is 90%. For enterprise, 125% is pretty good. So I grabbed some fresh data this morning that was kind of interesting. Some benchmark data. SaaS Capital, actually, if you're not on their mailing list, I encourage you to sign up. They do a great job of surveying private companies and sharing their research for free, and it's pretty interesting. So they talk about growth rate is positively and exponentially correlated with net revenue retention. And while gross revenue retention is table stakes, to have a shot at performance parity with your peers, retention's got to be at least 90%. So there's a couple of things in here that compares, median net and gross revenue retention by ARR. So you've got bigger companies, smaller companies, 98, 100, 102, 104, and then gross varies in the low 90s. And then by ACV, you can see, smaller contracts, larger contracts, pretty consistent. Smaller contracts, 105, larger contracts, 120%. SMB can be a great business. A lot of times I see, though, if you're able to move upstream, to the mid or large, they can be more difficult sales processes, but it tends to be stickier, and the company tends to be more valuable if you can move up that food chain. All right, total addressable market. I think everyone kind of knows what that is, but it's important. So do your homework. What is the real TAM? Buyers will do their own analysis. Some buyers are domain experts, so they'll They'll know the industry inside and out, so it's a pretty simple conversation. They recognize what you do and how it fits. Others, they're really smart people. They may have a strategy or a thesis, but they're not domain experts. So the extent that you can help them craft that can be helpful. Again, strategics, they're usually running a company in that space, so they know it's less of an issue for them. But generally speaking, if the total addressable market is small, if it's $100 million, people are, even if you're successful, it's still going to be a small business where, $1 billion or more is large. Rule of 40, most people probably know what it is, but if you don't, it's a little bit like some of the baseball numbers where they had two different percentages that shouldn't be added together and come up with a number that doesn't really make sense. And this is the same. So if your growth and your EBITDA percentage are greater than 40, it puts you in a pretty elite category. So if you're growing 40% with zero EBITDA, you're great. If you're flat with 40% EBITDA, it can be pretty impressive as well. All right, so I'm going to talk a little bit about strategic and financial buyers. I won't spend a lot of time on this slide. So financial buyers, just really quickly, Enron, what was it, 1990, Sarbanes-Oxley was put in place. Enron did some bad things. Sarbanes-Oxley was put in place to hold CEOs accountable for being not creating shell companies and ripping off your investors. So it was a good thing they put in place, but it added $1 to $2 million to the cost of going public. So $10 million companies now, with $1 million in profit, really couldn't go public because it would wipe out their profits. And so in step private equity. And guess what? They've done a really good job. I gave this presentation, I think like 4 years ago before COVID, and I honestly blew my mind how much private equity had grown when I gave it 4 years ago. But when I updated it today, I'm still a little bit in shock. I'll show that in a minute. But private equity had, 25, 30, 40% internal rates of return. So these small $100 million funds, 10 years later, were worth $1.6 billion. What would people do when they got distributions? They'd reinvest. So now 1.6, can't do my math. What's 1.6 times 1.6? These firms became massive. So what does that look like? So on the bottom left, I talked about how big private equity was. At that point, $1.5 trillion had gone to $5.5 trillion in 10 years. That's a pretty spectacular return. The New York Stock Exchange was worth $22 trillion at the time in 2017. So it represented about 25% of the value of the New York Stock Exchange. It put it on par with the GDP between Germany and Japan, actually above Japan and China. All right, so this is what I ran this morning. So this was 2017. So since then, it's gone from 5.5 to 12.8. So $13 trillion. And what's the New York Stock Exchange done? It's gone from 22 to 25. So you can play with stocks all you want. Maybe you could beat the stock market, but anyone that's had money in private equity, it's just almost unfair. And private equity includes angel investing in seed funds, but $13 trillion, it's now worth half of what the New York Stock Exchange. So it's not this small group of investors on the sideline. I mean, it's mainstream, and they're just they're deep in money, and they had free money for a while, which definitely helped to accelerate that. And now they've got large funds. They've been deploying it more slowly this year, and so there's a lot of dry powder in there. But part of the reason I make that point is that people used to think, oh, strategics is where I'll make a lot of money. Private equity, they're cheap and they'll try to lowball it. And that's really not true. You've got your bottom feeders in private equity, but you've got a lot of blue chip private equity firms that hire the best and smartest people, and they pay them well, and they buy good companies, and they pay fair prices, and they don't nickel and dime you with paper cuts when you're trying to do a deal. So I'm a big fan of private equity. And I also believe if you sell your company to private equity, or most often with small companies, you'll sell to a portfolio company owned by private equity. They'll want you to roll, and investors, they might give you the opportunity to roll as well, 20 or 30 or 40% of your money. Well, I also tell entrepreneurs, if you're going to have a wealth event, you're going to put $10 or $20 million in your pocket. You now have the problem of what are you going to do with that money? You can throw it all in the public markets. Probably should put a lot of it in there. It's not a bad place to be, but to have 20 or 30% in private equity, who is able to heads down put together a 3 to 5 year plan and execute against it without having to report quarterly earnings. There's almost no better bet out there. So anyway, it's a good place to roll your money. And most people I know who have done that end up making more at that second bite of the apple 3 to 5 years later than they did the first time when they sold 70% of the company. Okay, so enough about that. So I'm going to talk a little bit. So what is? If people don't know what private equity is, Riverside's one of the blue chip companies. They'll go out to investors, wealthy individuals, and pension funds, and they'll raise a fund. Small one is 100 million. The big one is 4 billion. They'll have some GPs and a management, and they create this fund, and they go buy a bunch of companies. They'll maybe have 70 million in equity, and they get a lot of debt, so they leverage it to kind of juice their returns. Then they'll go out and they'll buy platforms, and a small platform might be 10 million in revenue, and I'm just talking about SaaS private equity. A big one might be 300 million in ARR. So if you're in that category, you qualify for a platform. And that stems from, they'll have a strategy and a thesis. Again, these are all really smart people, and they're analyzing at a macro level what's going to change. One real life example was when COVID hit. They looked at, people weren't going to stores, so also the stores were shipping stuff to home. So look at logistics optimization for small and mid-sized e-commerce companies. And they went out and they would commit, $300 million to, and multiple PEs were doing this. So they go out and they buy a platform. And then they'll look at, $3, $5, $7 million companies to bolt on, merge them all together, increase the value of what they paid for it by 2 to 3x. This isn't VC. They're looking, if they invest 300, they want to sell it for 600 to 900 within 3 to 5 years. And this is where a lot of the companies end up. So this is where a lot of angel companies, they didn't turn into Remitly, right? They're not a $5 billion company. It's a $7 million company, which is great, right? And it's worth $35, $45 million. That's a great exit for angels and for founders. I mean, if they haven't raised 20 million bucks in VC money, but if they're capital efficient, those are great companies. So why do they buy these add-ons or tuck-ins? So they might want geographic expansion. Maybe they bought a HR platform in Europe, and you've got an HR platform in the US. Could be a product extension. So we sold a company, great company, 10,000 feet, to Smartsheet about 5 years ago, and it was a product that Smartsheet struggled to develop on their own, and so they bought these guys. It's been a great fit. Different product, the same client base. So let's say you're selling HR systems to small businesses, and you've got 50,000 clients, and your business sells something else to small business, but it's sold into HR, but it's completely different than the HR platform. Well, all they've got to do is a marketing campaign against those 50,000 clients, and they may generate 15 million bucks in additional revenue. Cross-sell, upsell, so they different customer base. You can sell the different products to each other, the platform and the add-on. Might be a desirable customer base. Maybe you've got Boeing as a client, and they've always wanted to get into Boeing, so they buy you to get access. And they do save a little bit of money, but I will tell you in SaaS, that's really not, unlike, like KKR that goes in and buys, I think it was KKR that bought Kmart, right? And they just shut down stores and laid off people. That's the old slash and burn private equity. And with SaaS, that's not what they want to do. You don't usually have that many employees anyway. They're usually super valuable people that know the solution. But there might be some redundancy in the back office. Okay, so often when I'll talk to, this is for entrepreneurs. I have people say, oh, my business is really exciting. People are reaching out to me all the time. That's great. I don't want to rain on anyone's parade, but they're reaching out to everyone. So the two primary reasons that they're reaching out is they're doing marketing. So private equity firms do marketing so that as companies grow up, they know they might be in a competition to win. They want to develop a relationship, and they want to have first dibs. Ideally, they want to try to buy you without you running a process so they can get a better deal. So often you'll see associates and senior associates, junior employees, cold calling, usually super smart, nice kids, and they're just doing their job. But they're not serious buyers. They're cold calling. They might be, they're reaching out to hundreds, if not thousands, of companies. The reason it might be interesting is that they might have an active strategy or a thesis, and they've actually done their research and analysis and identified as a part of that strategy or thesis, your company fits into that. Those are legit and worth having the conversation and keep them on a short list, even if they're not a good fit right now. And as I mentioned, they're usually trying to avoid a process because no one wants to pay more than you have to. Another type of buyer are search funds. And this chart's a few years old, but search funds, basically, they take a Stanford MBA, wealthy people. They're almost like super angels, but instead of writing $25,000 checks, they usually write $250,000 to $1 million checks. 4 or 5 might get together and they want to go buy a company for $5 to $10 million. And then they'll surround this Stanford MBA, and it literally started with Stanford MBA grad with smart, experienced people, and grow the company. And they've done really well. The last in 2020, they had an internal rate of return of 32.6%. So just phenomenal. They used to buy traditional companies, but now they've started moving into private equity or into SaaS. And I've gotten to know a lot of those folks. They're great to work with. They tend to be just like really nice people that want to invest in real companies. But they want to own it. So they're going to own the company. They don't have a small stake like an angel. So that's a good vehicle for some companies as well. Family office, so basically wealthy people. East Seattle Partners is one here in Seattle. Keeler's another local one. A lot of you know them. But they take family wealth and they want to invest in private companies. They are their own LP, so they don't have to produce a return to their LPs other than whatever the LP wants. So they can be a great source as well. There's a whole series of companies that are pretty remarkable that buy and hold, and they're not usually the premium buyers. So if you've got a great company, it's not usually you want to sell to, but if you've got a company that is underperforming, right? If its growth is flat, or you just got some inherent things that won't drive a higher valuation, they can be great homes. It's hard to, Constellation's the biggest. They do, so this is thousands. So they're actually $4 billion in revenue, and they've got a $29 billion market cap. So it's hard to argue with what they've done. There are a lot of spin-off, and these all come out of Canada too, like out of Toronto, but there are a number of companies that have kind of done a copycat version of that. And a lot of them they're great people, and many of them are willing to pay. They may not pay the highest price, but they'll pay a fair price. And a lot of them are, like I say, very smart people, super reasonable to work with. So this is another category. So strategic buyer, simple question or simple answer. It's just a real company. And so why do they buy? So again, geographic expansion, product extension. They might have the same client base or buyer profile, cross-selling, upselling. They've taken out a competitor, which can be tricky, but that's a whole other story. But competitors often the most likely one to buy you. They're also the most likely one to sign an NDA, do due diligence, just to learn everything about your company and then say we're not interested. So it's a delicate dance. Desirable customer base. I talked about synergies. So strategic buyer so the priorities of strategic dev. So do they have corp dev or not? If they have corp dev, it means they have a professional who's hired to buy companies. So it shows they're serious about buying companies. If they don't have corp dev, they may not have any or much experience buying companies. So there's some risk to that. Financials, they're often publicly traded. So, they've got to get it right. But you've got to also access to a lot of information on them. Technology is a compatible tech stack. They'll usually have a CTO that goes deep. Product side, competitor, I mentioned, makes it delicate. They want to go deep into the product and the roadmap. So even when they're legit and serious, it can be kind of delicate. They'll usually go deep on customers as well to really understand who the customer is, why the customers buy, are they happy with it. Go-to-market strategy, sales and marketing. Pipeline, they'll want to make sure the pipeline supports the forecast. So you want to make sure you use Salesforce, whatever you use, you've got it cleaned up. And then they'll look at cross-sell opportunities as well. So there are financials, there are strategics, and I alluded to this a little bit. Riverside's a good company. They own a company, Arcos. Arcos is a huge platform. Actually, I think since I built this slide, they actually sold Arcos. But the point still remains. We decided there's $13 trillion assets under management. A large number of B2B SaaS companies are owned by private equity. So you say, is it a strategic or is it a financial? Usually the add-ons are acquired by the strategic with the backing of the financial. So the majority of the deals we work with are to a strategic, but with private equity backing. The thing I like about that is private equity, they've got a checkbook, they've got money in the bank, the clock is ticking, they need to put that money to work. They're very motivated buyers. They tend to be very transparent, they move quickly. And if you enter a process with them, the certainty of a transaction occurring is high. The danger with just a pure, with a pure strategic that doesn't have a financial backer, acquisitions are often more of a nice to have. And if they have a bad quarter, whatever, they've got a big business to run. And yes, they'd like to add revenue. If the revenue goes way up, they may not want to buy. If the revenue goes way down, they may not want to buy. Things can happen. Private equity's got two jobs. One is to buy companies, and number two is to grow them. So they're very focused on that. So anyway, I throw this in here that I would say the majority of opportunities for companies with less than 20 million in ARR is going to have a piece of a strategic and a financial. I'm not going to read through these again. I think I'd be repeating myself. Let me talk about. All right, I'm going to wrap it up here, so leave time for questions. But so common deal structure is people will say, what do you want from my business? Like, well, I want, we're doing 5 million. I want 4 to 6x. I want 25 million. Okay, great. All right, that's what we all think about for a number. But what is a $25 million offer? If it's all cash, that's pretty cool. Often they'll want to roll. So if you roll. I'm going to do the math. So if you roll 20% of 25 million, 25 becomes 20, like cash, minus the deal expenses. If it's an all stock deal, well, if it's Microsoft, that's okay. Their stock is liquid, right? So it's not much different. But if it's a privately held company that may or may not ever go public, you just don't know. Then how do you value that stock? And then how much will it actually be worth, when and if it ever becomes liquid? That can feel pretty different. Or some combination of both, right? We had one last year where they proposed 50% cash and 50% stock. We see a lot of that right now because you saw that spike in multiples of investment. A lot of people are now trying to buy companies with that inflated stock, which is smart on their side, but it may not be great on your side if they're buying you a stock priced at $200 a share. And if they went out today, it's probably worth 50 or 100. So, and then what about the earnout, right? If it's a $25 million deal, if it's 10 million cash at close and maybe a $15 million earnout tied to hitting EBITDA numbers, that's probably not going to end well. If the 15 million is tied to hitting revenue targets, the only earnouts I like are tied to ARR. So if you grow $1 million in ARR, you get $1 million or 1.5 million paid out to you. That's a pretty fair win-win. It's hard to play games. But ideally, you want all cash. There could be time-based payments. If you believe that they're solvent and can make the payment, that's not necessarily bad. But again, all cash at close is better. Sometimes they'll offer retention, particularly for entrepreneurs that are heavily diluted, right? I've talked to people some people have 10%, some have 100%. It's a big difference, right? If it's a $20 million deal, that's a pretty different outcome. So sometimes they'll try to sweeten it with retention payments of $500,000 or $1 million spread over 3 years. Again, a bit of a win-win. If that person's key to the business, they want them to stick around. Their life may not be as much fun. So it's another way to put money in their pocket. I talked about cash stock combination. Indemnification holdback, I'll just throw that out there. Pretty standard that, they're assuming that everything you've said is true. They're going to do their due diligence, but it's like trust but verify. They're gonna pay the money, but they're going to hold back some percentage. Typically, it's 10% for 12 months. Sometimes it varies on either side of that. I don't think I've ever been a part of a transaction where that indemnification holdback wasn't paid. So I know there are cases where it hasn't been, but we've never been a part of one. So it's more like a holdback. You get 10% of it a year later. Just something to be aware of, because I've had entrepreneurs offered an all cash deal, and then when they see the docs come through and there's 10% held back, they felt like it was a bait and switch. And that's right. So I said, no, they say all cash at close, but that's a normal exception to that. Most deals are cash-free, debt-free. So that's excess cash. Again, remember that if some of your cash is due to the fact that you're prepaid on future service, that they're going to try to claw that back. And I could probably do a whole session on what does cash-free, debt-free mean. Some people say, well, boy, if I get to keep all the cash, then I'm gonna offer a discount to get people to pay me early. I'm going to stop paying all my bills. It's like, well, they're going to determine what your net working capital should be. So if you stop paying your vendors, your cash balance will go up, but your accounts payable is going to go up. And they're going to, when they pick a target, those are going to blend together. So it's a zero-sum game. So if you pull in payments, stop paying other people, yes, your cash will go up, but your AR will go down, your AP will go up. So your net working capital's going to change. That's why they'll pick a target so people can't play those games. And in the net working capital, it gets very confusing. All of the entrepreneurs we work with are super smart people. Most of them struggle with just trying to understand what that really means. But just recognize that will be one of the things to negotiate before a deal gets done. Unearned income, I think I've beaten that to death. All right, waterfall. I'm not going to go through all of this, but just recognize it gets remarkably complicated. You think, oh, well, I've got shares, there's money coming in, a couple expenses, and it all runs out. But they get remarkably complicated. Often there's a stockholders rep fund. You've got the target working capital. There's the indemnity holdback. Often there might be a cash portion, there might be an equity portion, there might be a customer holdback. So there are a lot of things get factored into this with payouts at different times, depending on how it works out. So I'm not going to go through all that right now, but recognize that's a thing. All right, what's the M&A process look like? They're going to build a SIP, confidential information presentation. That's the marketing material to market your company. They're going to do research on segments and all potential buyers, like why would someone buy the company? Then identify contacts, have they done previous acquisitions? And then why would this make sense? Build a financial model, so make sure your historical financials are correct, and then make sure that logically ties into a future financial model. That's a fair amount of work to do that. So the SIP and the financial model and the research are three heavy lifts of grunt work on the front end. Then there's the outreach. So blank executive summary goes out. Buyers are qualified. NDAs get signed. Then the SIP and the financial model get shared. If they look like a qualified buyer, then there's a fireside chat with the founder. This is where if you've got an articulate founder, it can be very helpful. If they've got a lot of honesty and high integrity, that all goes a long ways. There might be a demo. They'll do some light diligence. Then a data set to get an indication of interest. That's a 1-page offer. We're going to pay $25 million. It's going to be $15 million cash at close, $10 million in an earnout. I'm just making this stuff up. But then we ask for who has to approve this, who's aware of this, what's your source of funding. We want to make sure that you don't accept an offer from someone that it's like NIL right now. If you follow that, So these kids are being offered money that doesn't exist. It's not really there. So we do a lot of diligence on the buyers to make sure that they're legit. Once the IOIs are in, you select 2 or 3 to a short list. You dive deep with them, technology, talent, financial, product, and you negotiate the best LOI. Once you sign it, you go into exclusivity, so you can't negotiate with anyone else. At that point, your deal won't get better, and hopefully won't get worse. They'll do extreme due diligence, and then they'll create the purchase agreement. So I say the IOI is 1-pager, LOI is a 2-pager, and the purchase agreement is, can be 75 to 100 pages long. It's a lot of effort, a lot of heavy lifting. This is where a good attorney really earns their money, because they'll also be negotiating a lot of these finer points with the other attorneys. If you've got a good attorney, one that protects you and defends you and gets what you need, but does it without blowing up the deal by poking the other attorneys in the eye, that's a good thing. So structure, earnouts, terms, identification, reps and warranties, holdback. Tax planning can be a pretty big deal. Depending on how the deal is structured, can radically affect how much money everyone gets to put in their pocket. Employee contracts, non-compete diligence. Typically takes 4 months. We've done a couple in 4 months to the date. Typically it's 6 months. And then depending on how long this due diligence purchase agreement, this can be done in 30 days, which is pretty fast, but it can draw to 60 or 90 as well. But you have a lot of control over that. Okay. I'm roughly on time. Let me, feel free to just jump in. There's a couple questions. Okay, so much retirement, pensions, 401s, and university endowment funds. Yeah, it's true. Yeah, a lot of retirement pensions, 401s, et cetera, have moved in, and there's not been a lot of liquidations lately, so they've not had a lot of distributions. Any particular recommendations for what to consider offering, structure to do right by team, scenarios where we turn into more of an acqui-hire? Yeah, it's a good question. I think if there's upside, it's nice to share that with the team. You can just pay people a bonus. You can, if you don't want to issue stock, which can become complicated to people, if they don't have options, you can literally just pay them a bonus. I've had some CEOs say, well, I'm just going to give them money out of my bonus. And you got to be careful because it could be double taxation, because you're going to get taxed on it, and then they're going to get taxed on when you give it to them. So you're better off just have the company just work with the board, and it may come out of your pocket. That's okay, but just carve it out so that there's a bonus distributed, like a sale bonus when it's closed. The other thing, if it's an acqui-hire, is work with the acquirer to put retention bonuses in place for people. So that's another way where it's a win-win for the buyer. Especially an acqui-hire, you want people to stick around, so put some money in their pocket. When is leveraged buyout a good idea? It's a really good question. We had a long philosophical conversation on that. It's just like anything. It's like, in theory, you have a big mortgage on your house, you got a big payment. But if prices go up, you'll make more money over time. If you pay cash for your house, it's hard to do in Seattle, but you may sleep well at night, but it's just not, you don't get the leverage. Leverage is a multiplier. So it will accelerate your gains and it will accelerate your losses. So I'm not sure I have a good answer for that. That's probably a good philosophical discussion. I will say private equity varies a lot. Some are low leverage. Some pay cash right now. Cash is more common now because money's more expensive. When money was cheap, you saw people doing highly leveraged things. Yeah, I guess I'm just talking about it. I'm not giving a good answer there. All right. Perspective on management buyouts. You may want to spin back out. Okay, I'm not sure if that's really a question or a statement. What were the contents of the worst deals you've seen? Not sure what contents mean, but we've just unforeseen things can happen. I'd say we're doing this for 7 years, and this I know. I'd say that the hardest thing, smaller companies they're just a lot harder to find the right fit. They're just, that's probably the biggest thing. The financials I mentioned, terms. I mean, I have to think. I've seen some. I don't know if they're bad terms. We had one that had high customer concentration. So 60% of the revenue was with one client. The buyer was really concerned about that. So they put some massive clawbacks in it that if that customer left, which would be devastating to the buyer, then the seller would lose a lot. And it worked out fine. So, but it was pretty draconian what would have happened had they left, but they had the confidence that would stay. So that kind of aligned their interests. I mean, there are a lot of bad terms that buyers will try to put in, and you just need to say no or counter with something different. All right, what are the PE firms doing with these SaaS purchases to get the liquidity in 3 to 5 years that they require to pay their investments? Public markets. Oh, okay. So like the exits, that's a good question. That was actually one of the slides I was looking for. I had an older slide. Right now, there are probably it's probably 10 to 1 where exits. So it's like a food chain. Like the bigger fish eat the smaller fish. So angels start with the tiniest fish, and they often get acquired by a search fund or private equity. And then private equity turns around. The majority of private equity exits are to other private equity firms. So they may take a company, they buy a company for 10 million. They do call it, add-ons. They get to 30 million. They grow the company to 90 million, and they sell it to a bigger private equity firm that does the same thing, and they double, triple it, and they sell it to a bigger private equity firm. So, like I say, there's an almost infinite amount. I mean, there are companies that will pay multiple billions of dollars for companies. So there are a lot of companies out there that do that, and then some do go public. Over the last year, there have not been as many. I think the public markets are starting to open up again, but there are a lot of, as you can see, there's half as much money in private equity as there is in the New York Stock Exchange. So private equity is a pretty compelling, and they just keep getting bigger. Red flags we look out for. I mean, we look for companies that are civil. So we look for, just integrity, honesty, people that we want to work with. Things to watch out for, any financial games. Anytime revenue isn't what they say it will be is a huge red flag. Knowing the different buyers, there are some buyers. Well, so one thing I think it's important to watch out for, let's say you're a company and you've got IOIs and they range from 20 to 40 million. Well, you immediately drawn to the $40 million offer. But the one that's at 30 has had 15 Zoom calls. They've examined every document you've supplied, and they know your company inside and out. The one at 40 million had 1 30-minute fireside chat and threw out a high number. To me, that's a huge red flag because they're lazy. They don't want to do the hard work up front. So they throw a high price into the IOI. Because they haven't done any due diligence, if they're selected to the short list, it's easy for them to now do the diligence because there's now only 3 companies. And then they can say, oh, we didn't know this. Oh, we didn't know that. And boy, this revenue really looks to, boy, and they can find all these reasons to reduce their offer from 40 down to 20. So the $30 million offer was guaranteed. So there's some big things and some little things that you need to watch out for. All right, I'm running over. Any other questions? That's all I see in chat. Apologies if I missed anything. All right, I'm going to wrap it up. Thanks for joining. I hope you guys get something out of it. So take care. Enjoy the rest of the day.